Jeffrey, Mayberry, let's bring you back in and talk a little bit about concentration and the concept of equal weight versus market cap, which is one of the strategy you managed. As we think about, let's get a little bit specific on ideas for 2025. Concentration has been a big topic this fall, especially as the year approaches the end. The Mag 7 leadership, the mega cap leadership. And so talk through how to handle that. Equal weight is an intuitive way to do that, but give us some data on how does that compare to a market cap approach? Why does this work? And what's the investment case for this right now?
Yeah, and I think I like this chart, not because it's really, it's just more eye-popping in terms of looking at the top weights, and we like to throw that equal weight line in. Obviously, it's a flat line there. But really, everyone knows about the market concentration risk, and certainly it's hard to get out of the, those winners when they're winning. But I think that people are starting to be much more aware of the concentration risk, much more aware of how much the S&P 500 growth or S&P 500 return this year has been driven by kind of those 7 mega cap names. And that can't continue forever. Certainly, if they were continue to grow at this rate, then they would double up more and more of the market cap of the index or of the stock market. And really, when you think about it, something's going to have to give. And it's a little bit different now than say the .com bubble, because these companies have earnings, and you're not as worried about them. They're not going to collapse, go to zero, but they can kind of more normalize, get back to more normal levels, and there still would be some pain. And so we think it's a good time to kind of diversify away. So not necessarily get out of those names totally, but maybe start adding in some, what we like is the equal weight, because it's the same names, the same kind of idea, but you're not going all in on these larger companies. It's an equal weight to all the other companies. And so really we think that it's a way of giving you a little bit more diversification. When you have these high concentration, it kind of leads to more volatility. You have more idiosyncratic risk in like the overall S&P 500 index. So an equal weight portfolio diversifies a way that gives you a little bit more gives you more diversification. You're not so concentrated, obviously, by definition. And really, when you look at it, you're kind of getting paid to take on that risk. Over time, over the kind of a long period of time, the equal weight portfolios tend to outperform. And a lot of that is because your market cap portfolio, you buy it once and you just let it grow, and everything adjusts by itself. Equal weight, you have to rebalance. We rebalance every quarter. And what you're doing in those rebalance states are you're selling your winners, you're buying the losers. And, as things revert back to the mean, you get some added benefit from that. And so you get that kind of what they call free lunch in terms of being able to, that rebalance of the portfolio. And so we like that, equal weight side of things. I really think that, now, maybe right now is not the perfect time, but start legging into these trades, start getting some more diversification to the portfolio, not being so super concentrated in those 7 names. Even though it's hard when they're winning, that's the time to do it, is when it's hard to do.
Yeah, and if you, just watching some of the audience questions that have been coming in all morning, you really get a sense of, we've been hearing a lot about this moderation of pace in terms of leadership of your Mag 7, mostly associated with the artificial intelligence story, the semiconductor story. But, it's moderation, but, that's not the same as saying giving up leadership. So it's an interesting idea that, start diversifying, but it's really a long-term trade.